Hi, I'm Tom Lydon, editor of ETF Trends here in Washington, D.C. at the Charles Schwab Impact Conference. I'm here with Todd Rosenbluth, who's Director of Mutual Fund and ETF Research at S&P Capital IQ. Todd, thanks for being with us.
Thanks, Tom, for having us.
Listen, I know you guys get your finger on the pulse all the time, especially on the ETF side. With markets hitting new highs and flows just going through the roof, what are some of the hot things that you're seeing at S&P Capital IQ?
Yeah, so what we saw was strong interest in U.S. equities, in particular in large cap, in mid cap, and even sector ETFs. We saw strong inflows throughout October, and we think the trend is favorable going forward for these investment styles.
Yeah, so sectors have been really hot. We've had some new people enter the market. What do you think about this new launch with Fidelity?
Yeah, it's entering a very crowded market. Obviously, State Street's there, Vanguard's there, iShares has some lesser known sector or investment themed products. We think with Fidelity.com, they really have a portal that can help people out to compete with what's happening here at Schwab from a discount perspective.
Yeah.
But you're right, investors are really going tactical. We've seen strong interest in industrials, strong interest in consumer discretionary, two sectors that we at S&P Capital IQ are favorable on. They're very cyclically slanted as a strong U.S. economy helps things.
So sectors, they're getting traction. I mean, assets are flowing, but as you say, mostly from a tactical standpoint, not necessarily core, right?
Yeah, so investors still are going to have their large cap, their mid cap, their small cap, or even their European exposure with more diversified ETFs. But the sector ETFs allow them to be nimble, to be able to choose a cyclical or a more defensive slant and use advice like what we have at S&P that can tell people where we think they should go.
Right. So what other areas of the market are getting your attention? Because things are moving fast.
Yeah, we keep seeing new ETFs launching. We've seen ETFs that have gained a lot of traction that don't need a 3-year track record. PowerShares Low Volatility ETF, SPLV, is just one example. PowerShares also has BKLN, that's the senior loan side of things, but lots of other things in the fixed income space that are relatively new. Investors are seeing the interest in them because, again, they allow them to be tactical, focus on short-term high yield, for example, which has been one of the more popular areas in 2013.
So rate risk, is that on the front of advisors' minds these days? And are you seeing with all these short-term, actively managed fixed income products that are hitting the marketplace, are they going to continue to get traction?
We think so. Interest rates are only going to move higher, we think, obviously, as the Fed begins to taper, probably in 2014. Mm-hmm. So you have to make sure you're aware of the duration characteristics of your portfolio. And so the high yield duration or low duration products, SJNK from State Street or PowerShares short duration high yield, HYS, are two such ways that have gained interest, as well as some floating rate products such as FLOT from iShares. Good ways to get yield in a rising interest rate environment, we think, at S&P Capital IQ.
So Todd, let me ask you this. $2.7 trillion in money market funds.
Yeah.
We got an interest rate headwind that we're facing. How safe are money market funds, and do you feel that advisors are starting to diversify their cash holdings out of money market funds into these short-term ETF products?
Yeah, so yes, the short answer is yes. We've seen a number of products come to market. iShares has a product called NEAR that is a short-term product that is very low interest rate sensitive. We saw some other actively managed funds. Mint has had success over the years. We've seen Franklin enter the space as of late.
GSY over at Guggenheim. It seems like it's getting crowded pretty quick, right?
It is, but with rates as low as they still are, and obviously money markets are as low as they get, investors want to have diversification, they want to be nimble, and they want to make sure they get some return out of it, whereas you're not getting as low as rates are in the money market side. So I think we're going to see continued diversification, and ETFs, because of their transparency and their low cost structure, it makes a lot of sense for investors to go that route.
So, if you had a gun to your head, what would be the biggest surprises that you think we're going to see in 2014?
Yeah, I think we're going to see more of the active side of things. I think we're going to see more ETF provide or mutual fund companies enter the space that we haven't seen. Franklin just recently did so. We saw JP Morgan moving into that space. Other firms, I think, are going to see the writing on the wall that they need to defend their mutual fund business and have some alternatives. And maybe we'll see the day where money actually goes into actively managed equity products.
We've been waiting a while.
We have been, but it's still the early innings in the ETF market. We still think we've got room for that space to grow in ETFs on the active side. I think they're still going to gain some interest as we see people get more comfortable with the strategy.
Great, Todd. Thank you. Thanks for being here.
Thanks a lot.